Lending platforms are a key part of decentralized finance, or commonly known as DeFi ecosystem. But their institutional features mostly facilitates speculation in crypto assets rather than real economy lending. Crucial feature of DeFi lending is that it relies heavily on crypto collaterals. This is because, unlike in traditional finance, market participants in DeFi are anonymous. With that, we will be discussing on DeFi lending, intermediation without information, which is a Bank for International Settlements or BIS publication. This shows lending platforms, a key element of decentralized finance, stand at the center of this recent crypto turmoil. Total value locked in DeFi lending protocols peaked at 50 billion USD in early 2022, up from nearly zero at the end of 2020. Lenders are attracted by high interest rates that often far exceed those on bank deposits or money market funds. Borrowers, in turn, use DeFi lending to gain leverage exposure to crypto assets or adjust portfolios. However, the recent collapse of Anchor on the Terra blockchain and Celsius restrictions on withdrawals have shaken confidence and put a stop to the rapid ascent of crypto lending. Crucial feature of DeFi lending is that it relies heavily on crypto collaterals. This reveals smart contract assign each collateral type a haircut or a margin that determines the minimum collateral borrowers must pledge to receive a loan of a given amount. High price volatility of crypto assets means that there is over collateralization. Collateral required tends to be much higher than the loan size. Minimum collateralization rates typically range between 120% and 150% on major lending platforms and depend on the expected price appreciation and volatility of the crypto assets serving as collateral. As DeFi loans are disbursed in crypto assets and secured by crypto collateral, they do not currently finance real economic activities. This illustrates in booms, appreciating prices mean that collateral values increase, while collateralization ratios fall. In turn, borrowing constraints relax and loan volumes expand, feeding into further price appreciation and boosting volumes. In busts, however, loans are liquidated as prices, and hence collateral values decline sharply, suppressing lending activity. This mechanism is further amplified when borrowed crypto assets are used as collateral for additional loans, akin to rehypothecation, giving rise to collateral chains. For example, a borrower can post $100 in crypto collateral to borrow $80 of stable coins and then use the stable coins to borrow $60 of another crypto asset when a trading opportunity arises. For a given stock of collateral, total amount of lending that can occur is inversely related to collateralization rates. Lower collateralization rates increase the monetary multiplier. This demonstrates interconnectedness of the various components of DeFi lending can exacerbate procyclicality, as it implies that shocks to part of the DeFi ecosystem can affect the system as a whole, as evidenced by the recent collapse of the algorithmic stablecoin Terra USD, known as UST. When the value of USD plummeted from $1 to almost zero in a few days, it sent shockwaves through the system. As USD dropped below its peg, users scrambled to pull their USD out of the Anchor protocol to burn them and mint $1 worth of new Luna in the hope of selling Luna and making a profit. However, given the size and speed of the shock, confidence in the whole system was shaken, meaning that there were not enough parties willing to buy all the newly minted Luna coins. Consequently, price of Luna crashed, collateral values declined and fell below their liquidation ratios. So liquidations of DeFi loans spiked as depositors feared that the collateral could become impaired. They quickly withdrew their funds in a full-fledged platform run. Loan volumes collapsed. Run on Terra quickly spread to other cryptocurrencies and has brought to the fore a centuries-old lesson. A financial system is inherently unstable without a lender of last resort. Beyond inducing greater procyclicality, need for collateral also stand in the way of financial inclusion and democratizing finance. Declared goals of DeFi. Across the world, asset rich tend to have better access to financial services. The financially excluded, on the other hand, often own few to no assets. They remain excluded also in DeFi, which, due to over-collateralization, actually requires participants to own more assets than they wish to borrow. Unless the borrower is wealthy enough or was lucky enough to benefit from the price rally of cryptocurrency early on, DeFi fails to cater to households and small businesses who need capital to fund productive investment. Even if access to credit on DeFi platforms is in principle open to all, DeFi lending, as currently designed, fail to foster financial inclusion. On the other hand, fintech and big tech lenders acquire substantial digital information about their clients and use it for credit scoring through machine learning algorithms. As a result, these lenders can better gauge the riskiness of borrowers and often extend loans without collateral, enabling significant gains in inclusion. Limitations of DeFi lending make elements of genuine innovation. Smart contracts can complement automated underwriting in traditional finance and help to bring down the costs of financial intermediation. Composability, the ability of DeFi protocols to interact with one another, allows end users to combine various money Legos to build customized financial products. This possibility can be particularly relevant in complex chains of transactions such as trade finance. Harnessing the benefits of these innovative elements will require substantial changes. First, DeFi lending must engage in large-scale tokenization of real-world assets, representing assets such as building or capital equipment on the blockchain will serve as collateral underpinning loans, would be particularly beneficial for SMEs which have more limited access to finance. Second, to serve the unbanked or underbanked, DeFi will need to abandon anonymity and use real names, and ultimately to fall within the regulatory umbrella. While all these initiatives are in their infancy, they highlight a growing trend in DeFi to rely on forms of centralization in one way or another. These developments suggest that the similarities between DeFi and legacy intermediaries are increasing, which has two important implications. The first is that elements of DeFi, mainly smart contracts and composability, could find their way into traditional finance. The second implication is that once more, decentralization proves to be an illusion. Reference for today's presentation is BIS Bulletin, published on 14th June 2022. Thanks for watching.